welcome back to The Explainer. So today we're tackling a massive question. Why on earth is a geopolitical conflict happening thousands of miles away, directly cranking up your monthly mortgage payment right now? I know, it sounds totally disconnected, right? You read the international headlines, then you look at your bank app, and it just doesn't make sense. But trust me, as we're going to see, the thread between those two things is incredibly direct, powerful, and literally driving the economy today. Let's get into it.
Okay, here's our macro to micro game plan for today. We're looking at 1, the global shock, 2, the local ripple, 3, the RBA's reaction, 4, the mortgage reality, 5, the budget squeeze, and finally, 6, what happens next. Starting off with Section 1, the global shock, geopolitics and fuel. Okay, so to really understand the forces squeezing our wallets at home, we've got to look abroad first. The recent US-Iran war has completely upended global supply chains. And look, this isn't just distant political news. It's a massive economic earthquake. It's triggered some wild volatility in energy markets and kicked off what economists call cost-push inflation all over the globe. Basically, when the supply of a globally essential commodity like oil is suddenly threatened, the cost to get your hands on it absolutely skyrockets everywhere. But here's the fundamental problem, and the macroeconomics experts at the University of Sydney hit the nail right on the head here. Domestic monetary policy, basically the tools our central bank actually has, is totally 100% powerless to lower global fuel prices. Right? The Reserve Bank of Australia can't magically pump more oil or stop a war. So this creates a literal nightmare for them. Their task was controlling inflation, but the actual root cause of the shock is entirely out of their hands. Moving on to Section 2, the local ripple, transport and inflation. So how does a distant shock like that actually wash up on our shores? Well, it hits us right at the petrol pump. And honestly, if you stared in absolute horror at the Bowser numbers lately, you already know exactly what I'm talking about. According to recent ABS data, we just saw a staggering 8.9% surge in transport prices over the 12 months leading up to March. To put that into perspective for you, that is literally the largest monthly increase on record. No joke. Every single time goods are shipped, every time you commute to work, that global shock is just draining a little bit more cash from the local economy. Unnaturally, all that expensive transport fuels a massive 4.6% jump in our local inflation data over that very same period. This right here is the textbook definition of cost-push inflation. Prices aren't going up because we're all out there on massive shopping sprees. They're going up because the raw materials, like global energy, cost more. And to make it even worse, this is all happening while our domestic demand is still outpacing supply. It's just the perfect storm. Which brings us to Section 3, the RBA's reaction. Rates hit a 16-month high. So how does the system defend itself? Let's check out the timeline. This is the central bank's very clinical attempt to fix this persistent inflation. The RBA just raised the official cash rate for the third successive time this year. They went with a standard 0.25% hike, bringing the official cash rate up to 4.35%. That's the highest it's been in 16 months. And what's absolutely vital to understand here is that these back-to-back hikes have totally wiped out any tiny bit of relief borrowers saw earlier in 2025. That reprieve? Yeah, it's totally gone. Now, you might be wondering, why are they doing this if they can't control the price of global oil? Well, they're doing it to basically anchor your expectations and stop what's known as second-round effects. It's like a vicious cycle. Step 1, global prices rise. Step 2, workers see this, assume everything is going to stay expensive forever, and demand higher pay just to survive. And Step 3, businesses have to raise their prices even more just to cover those newly increased wages. The RBA is hiking rates to break that cycle. They're trying to forcefully tell the economy, hey, this high inflation is not permanent, hoping to stop that wage price spiral before it completely runs away from us. All right, Section 4, the mortgage repayment reality. Let's zoom right down from the lofty halls of the central bank directly to your kitchen table. The impact here is immediate, and man, it hurts. According to CanStar, if you're an average owner-occupier with a $600,000 mortgage and 25 years left on the clock, today's standard 0.25% hike instantly slaps an extra $91 onto your minimum monthly repayments. That single move just pushed the average variable home loan rate up to 6.26%. But wait, we can't just look at this one hike in a vacuum. If you stack up all 3 rate hikes from this year, that exact same household is now paying an additional $272 every single month. Spread that out over the course of the year, and we are talking about more than $3,200 in extra mortgage payments. That's $3,200 that literally evaporates from a family's disposable income, rerouted just to service their debt. Ouch. Let's look at Section 5, the budget squeeze. Needs versus wants.
Now, when not much extra money is bleeding into your mortgage, it forces some really tough choices, and it's totally reshaping the average household budget. Because of this squeeze, we're seeing a massive, stark divergence in how money gets spent. Non-discretionary spending, so your absolute essentials, the stuff you literally need to survive, surged by 3.4%. But compare that to discretionary spending, the nice-to-haves, the wants, which barely budged, rising only 0.6%. Households are basically going into survival mode. The March spending data brilliantly illustrates this reality. Forced transport spending soared by 5.1% as we all paid more at the pump. Food spending rose 1.7%, mostly because people were doing some precautionary stockpiling. But look at hospitality. Spending actually slumped by 0.9%. So yeah, people are definitely tightening their belts, cutting out the Friday night dinners and weekend entertainment, just to keep the car running and the pantry stocked.
Finally, Section 6. What happens next?
So, with all the essentials costing more and our budgets getting squeezed from both ends, global fuel shocks on one side, local rate hikes on the other, where does the economy actually go from here? Well, the data is kind of confusing, honestly. Economists from Oxford Economics and Indeed are warning that even though these rate hikes are actively chewing up our disposable income, overall household spending strangely jumped by 1.6% in March. Yeah, somehow people spent more, even outside of fuel. Because this domestic demand is somehow still outpacing supply, further interest rate paying is pretty much forecasted for sure. Experts are warning that these intense budget pressures are highly unlikely to ease up anytime soon, and we might see overall economic growth slow down considerably.
Which leaves us with one absolutely critical question to consider as we wrap up this explainer. The RBA's entire game plan relies on inflicting just enough financial pain to force us all to stop spending, which eventually cools down inflation. But will our collective household spending actually slow down fast enough to halt these aggressive rate hikes before everyday kitchen table budgets completely snap? It's a serious high-stakes balancing act, and, well, it's one we're all living through right now.